Hi, I'm the Tax Geek with more of your taxes oversimplified. Today we're going to cover the tax advantages available to homeowners and hopefully dispel some misconceptions about the effect homeownership can have on your taxes. There are three primary tax advantages to homeownership. First, interest paid on a home mortgage can be deductible. This includes interest on indebtedness of up to a total of $750,000 on up to 2 homes. This interest must be acquisition debt, which is debt incurred to buy, build, or substantially improve your home. Interest on home equity loans that don't meet this criteria is not deductible. For example, interest on a home equity loan to renovate your kitchen is deductible, but interest on a home equity loan used to pay for a wedding or vacation isn't. If you pay points to obtain a mortgage loan, they are usually deductible in full when paid if the loan is for acquisition debt. Points on refinances, second mortgages, or home equity loans must be spread out over the life of the loan using a process called amortization. Here's an example. Jill pays 2 points to obtain a $75,000 15-year second mortgage to expand her home. 1/15 of the points, or $100, is deducted each year until the loan is paid off. If she pays off the loan early, any remaining points are deductible in the final year of the loan. Second, property taxes paid on your home can be deductible. This includes any tax that is both assessed periodically, usually annually, and is based on the property's value, which is called an ad valorem tax. Separately stated fees for city services and specific assessments for local improvements are not deductible. And third, owning a home can provide tax-free capital gains when sold. When you sell a personal residence at a gain, you are entitled to exclude some of that gain from capital gains taxes. The exclusion is $250,000 for single people and $500,000 for married couples. You must have lived in the home for 2 of the last 5 years prior to the sale. If you don't meet this requirement, the maximum exclusion is prorated over the months you lived in the home. However, there are several exceptions to this rule for job or health-related moves, the recently divorced and widowed, and military personnel on extended qualifying active duty. For long-time homeowners with substantial increases in property value over the years, this exclusion can provide significant income that is not subject to taxation. It all sounds wonderful, doesn't it? However, many new homeowners prepare their first tax returns after purchasing their homes and discover the tax benefits aren't as much as they thought they were or are not there at all. There are a number of factors that have contributed to this phenomenon in recent years. First is the Tax Cuts and Jobs Act, which took effect in 2018. Under the Act, the standard deduction was doubled for all filing statuses. This act also limited mortgage interest deductions to interest on the first $750,000 of mortgage indebtedness and eliminated deductions on mortgage interest for loans that were not acquisition debt. This new standard deduction, combined with very low mortgage interest rates, makes it extremely hard for most homeowners to have deductible interest that, when combined with their other deductible expenses, exceed the standard deduction. This is especially true for married couples. Another aspect of the Tax Cuts and Jobs Act is the capping of deductions for state and local tax to $10,000. Prior to the enactment of this law, a high-earning married couple with a large home in a high-tax area could itemize deductions even without considering mortgage interest and other deductions. Today, the $10,000 limit doesn't even get a married couple halfway to their standard deduction. These two provisions in the Tax Cuts and Jobs Act have greatly reduced or eliminated any immediate annual benefit of homeownership for most people. However, in any case when the home is sold, the exclusion of most or all of the gain from taxation is still a powerful way to build wealth tax-free. So all that being said, Why should you buy a house if you don't save on taxes? There are many good reasons to buy a home, but saving on taxes should not be your primary reason or even a reason at all. You buy a home for you and your family to live in. You buy a home to put down roots in a community. You buy a home to escape landlords who raise your rent at will and possibly even sell the property out from under you. And you buy a home to accumulate long-term equity and wealth. In other words, a home is a people shelter and not a tax shelter. And as usual, there are additional resources in the description that go into this subject in much greater depth. If you found this video informative, please give it a thumbs up and subscribe for more content. If you think someone else could benefit from this video, please share it. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. Thanks for watching, and stay tuned for more of Your Taxes Oversimplified.